Hello and good afternoon. Welcome to this podcast on carbon-linked bonds. My name is Nico Heller, and this is Reboot 2030, the Democracy School's podcast and YouTube channel. My guest today is Bob Litterman. To many, especially on Wall Street, Bob is an absolute legend. He spent 23 years at Goldman Sachs, where between 1998 and 2009, he was in charge of their quantitative resources group in Goldman's asset management. And prior to that, between 1994 and 1997, headed Goldman's firm-wide risk department. During his time at Goldman's back in 1990, he also co-developed the well-known Black-Litterman financial model, together with Fisher Black. Since leaving Goldman's, he's co-founded Kepos Capital in New York and chairs the risk committee. He's also on the boards of numerous nonprofit organizations, including the World Wildlife Fund, the Woodwell Climate Research Center, and the Climate Leadership Council, where he serves as co-chair. According to Bob, many private investors are nervous about investing heavily in climate solutions because they lack confidence that such investments will pay off. Governments might promise fossil fuels and other carbon sources to be very expensive in the future, but they're notorious for saying one thing and then doing another. In economics, this is a well-known problem and is referred to as time inconsistency. Kydland and Edward Prescott won a Nobel Prize for their work on that. When it comes to climate change, investors apparently worry that governments might back away from their commitment to a high carbon price if there is a substantial backlash in political or economic terms. Bob argues that a carbon-linked bond market would turn an empty promise into one that would be costly to break. Because if a government didn't meet its carbon price target and didn't compensate bondholders by paying them more as a result, it would be in default, which is something governments really don't want. At this point, this is simply an idea. I've therefore invited Bob to convince me that carbon-linked bonds really could mitigate global warming. Now, I believe, if I'm not mistaken, Bob has already arrived, so let me invite him in. Hello!
Oh, Nico.
Bob, thank you very much. Good to see you.
Nice to see you.
Really, great. Sorry for the kind of the slight mix-up. We changed to wintertime just a week ago, and so that obviously accounts for that. I'm so glad that we managed to connect now. It's a real honor, and it's really an interesting story, I think, and I think our listeners should know this because I have hardly ever met somebody in your position as approachable. And I think this is really both a sign of how important this issue is to you, and also, if you like, a sort of say something about your character. What happened is I read an article about you in the New York Times, and that really triggered my interest in what you do around the idea of carbon bonds. I wrote a short email to you, and really within an hour, I had a response. What a result. Bob, thank you ever so much. This is brilliant. Now, I have already given a very short introduction about a very long life and a hugely successful life, I should add. I mean, you're an absolute icon, really, to many, and it is interesting, you know, because of course I have a business school background myself, but of course I never pursued that particular avenue. But it's really amazing to see somebody who just through his quantitative thinking around risk and statistics has been able to be so hugely successful. Amazing. Bob, now,
thank you so much.
There will be a lot of people out there who will be thinking, well, somebody spent 23 years at Goldman's, a company who presumably spent a lot of investment capital on, you know, oil majors and this and that and the other. What kind of right does that person have to, when he retires, then to all of a sudden change sides and to become this good person? I think this is a sort of a cloud that a lot of people in the environmental field would place above your head, rightly or wrongly. But I want to dispel this because this isn't about, you know, that at all. This is a much more specific conversation we're having here, and also, of course, you know, interestingly enough, your expertise in risk, which you have put to very, very good use for investors. you are now putting to very, very good use for the environmental movement. And so I think there's in that in itself, there's really some real great benefit in that. But what would make somebody like you, who's essentially spent his life on Wall Street, to then kind of, hang up, your hat and say, and now I'm going to basically try to fix the climate crisis. What triggered that?
Well, thank you. When I was on Wall Street for 23 years, I didn't think of it as, having a problem. I thought of it as, at the heart of the market economy and connecting investors with, entrepreneurs and so on. And, the quantitative background that I brought, I don't know, for me, it was kind of like being a kid in a candy store. There were just so many interesting problems to address. And I brought some tools from academia, as you say, risk management, statistics, econometrics. And we found they were very useful in solving a lot of problems on Wall Street. And then when I retired, with a background in risk management, one of my partners from Goldman, who was very involved in the environmental space, asked me if I'd be interested. And I said, it seems to, I was, and in particular, I thought climate change looked like a risk management problem that was not being addressed very well. And maybe I could add something. I remember I was at a lunch and I offered that, this problem looked to me like it was pretty simple. We weren't pricing the risk. And if you price the risk, you solve the problem. And, my partner said, well, Bob, that's a brilliant insight from an economist, but no one seems to know where to price the risk. And I'll be honest, that kind of sucked me in. I thought to myself, well, that can't be true. There's got to be some academics out there who thought seriously about this, and they must have a pretty good idea. So let me follow up on this. I can read the literature. And I did. And I discovered that an old friend of mine, I kind of knew this, Bill Nordhaus, who had been a macroeconomist. He and I had crossed paths, decades earlier. And he'd already, been working for a long time in this climate space. So I read his stuff. And it did seem to me that there were some improvements that could be made. Indeed, that on Wall Street, we had used what we call asset pricing or risk pricing, and it requires you to look at certain covariances. And that hadn't been done in the climate literature. And so I started working on this and reading more and got involved with some other academics who were, in the environmental space, Gernot Wagner, and the financial space, Kent Daniel. And we eventually wrote a paper that was published about where to price carbon. And indeed, it took a risk management perspective on it. I just think it was natural to think about it from a risk management perspective.
Absolutely.
And when you think about that, you start asking different questions.
Totally.
You stop worrying about what you expect, and you start worrying about, well, what could happen in a worst case scenario.
For the benefits of our listeners, let's make a sort of a very basic distinction here between the idea of the carbon linked bonds, which we're going to come to later in our conversation, and sort of the risk of climate change. Because I think, of course, the beauty about the CO2 model, or the kind of the carbon, is that we're talking ultimately about almost like a single variable. But of course, the climate risk is a multi-variable problem, far more complex than just managing CO2. And of course, you are an expert on risk, and you've thought at a very deep level, of course, about climate risk, and you're advising clients, on investment decisions relating to climate risk. How do you think about not the CO2 aspect of it, which is one aspect, whether that goes up or down in price? We'll come to that later. But the broader picture of climate risk, which to my way of looking at it would include anything from certain political risks, to certain environmental risks, to certain social risks. And it's a really, really difficult kind of mix to look at and to see what would happen, on a political, on an environmental, on a, and so on and so forth. And indeed, of course, also on an economic, because they're all intertwined, level, if global warming would reach certain levels. How do you approach this problem from a risk management perspective?
Yeah, well, you've done a pretty good job there in terms of your introduction. There are many different dimensions to it. I would say that right now, and maybe the place to start is where we're seeing impacts already, which is with respect to extreme weather. And you are seeing now that, and for me, I was part of a working group on extreme weather and financial risk. We wrote a report for the president's office. This was the President's Council of Advisors on Science and Technology. And the report, which we published last April, basically said, look, the weather has already changed. The distribution of outcomes today is different than it has been historically, and it's going to change further. But it's changing along many different dimensions. So most people, including myself, kind of have this notion that the distribution of outcomes somehow is moving, let's say, to warmer outcomes. It's shifting. But that's true along the temperature gradient. But what's much more important is that it's becoming fatter tailed, that the total energy in the atmosphere is higher. There's more water in the atmosphere and more heat in the oceans. And so what happens is that the tail events, the unlikely events that used to happen, very seldom, are now happening more often. And as you think about damage from extreme weather, there's a common relationship between the frequency of an event and the amount of damage from that event. So in particular, events that happened once in 100 years historically were kind of the ones that would wipe you out because you've never seen them, you're not prepared for them, they're not in the building codes, and so on. And it doesn't matter whether you're talking about wind or rain or heat or drought or wildfire, any of the dimensions that are affected by weather have more extreme outcomes. So you saw a cold snap in Texas a couple of years ago that they weren't prepared for because they never seen that kind of cold and that length before. Similarly, we had wildfires in California, and they're having more hurricanes and stronger wind speeds and hailstorms and tornadoes. You can go on. And in every one of these dimensions, what used to be the 100-year event, the 100-year flood that would wipe everyone out, is now happening more often. And so the insurance companies are aware of this, and they're pulling back. You have some states, like my state of California, which has much higher wildfire risk now, and the insurers come in and say, well, we've got to charge a lot more for wildfires. Maybe it's 4 times more or 5 times more than we have charged in the past. And the insurance commissioner says, well, I don't see the evidence for that. And they say, well, it's in these models or whatever. It makes it a lot harder to underwrite insurance. The reinsurers won't underwrite it if they already have too much of that risk. But the bottom line is the real risk has increased. And so the insurers, who have a 12-month horizon anyway, they're saying, all right, we're going to pull back. They're not exposed. A lot of people falsely assume that the insurers have an incentive to solve this problem. They don't. They're not exposed. They're going to pull back. And so then what happens, at least in the U.S., is that the state comes in and starts underwriting the insurance. But of course, they can't make it profitable any more than the private sector. So either they subsidize it, and that's going to fall onto the taxpayers, or they reduce the coverage. And ultimately, you get these big events, and they fall on the federal government. So when we talk about the financial risk, ultimately it's going to come back to the federal government. And where it's starting now is with extreme weather. But what most people don't understand is that it's just starting, and it's going to accelerate. Sea level rise in particular over my lifetime, it's been rising, but very slowly. And so maybe so far a couple of inches, 2 or 3 inches on the east coast of the US. It varies around the world, but it's going to start going faster and faster, no matter what we do for the next several decades. And so on the East Coast, scientists expect maybe 6 feet of sea level rise, something like that by 2100. So you can see it's going to be more than just an inch a decade or something.
Let me just intercept here. What I find interesting about sort of complex dynamics, like sort of climate risk, and you would find similarly complex dynamics in certain corners of the financial markets, capital markets. Psychology starts to play a really big role, doesn't it? Because when you can't really empirically model it entirely, when there's a lot of assumptions that feed into your model, then of course psychology kind of plays quite sort of a, if you like, sort of an increased role. So in other words, the perception of how problematic the climate development is will have a direct impact on the actual perception of risk. Isn't that a fair point to make? So if people begin to panic about crop, whatever kind of yields or whatever it might be, then whether they materialize, or not, is almost secondary, because the markets will build that in.
Well, first, you said a lot of things there, and the first thing I would agree with is that people are not rational. Okay, so when you say psychology, I'm thinking, well, yeah, emotions, all kinds of things, and we know that people have biases. So I guess I'm not sure where one goes with that. I don't think it says necessarily that people are going to wake up overnight. Some people think, oh, all of a sudden people are going to wake up and realize, and there's going to be, just a crash in the markets, or somehow it's all of a sudden going to be priced in. And markets don't work that way. Financial markets are very much forward looking. And so the valuations today are build in a lot of uncertainty about the future, and there is tremendous uncertainty about the future. So you can imagine, technology gets us out of trouble somehow. That
what I'm referring to,
pulling CO2 out of the atmosphere is
Bob, what I'm referring to here is something quite specific in a way, and I should probably kind of said that, is this notion of trigger points. So you get these trigger points in the actual, in kind of in the natural environment, that methane gases, because of whatever permafrost is kind of melting, and then more gas is released in the atmosphere. You get trigger points at various levels within the kind of sort of like, physical environmental field. But then people also start talking now about social trigger points and political trigger points. And I wonder whether you see these trigger points as well, and how you feel that, because it's when I'm talking about panic, so when I talk about sort of like a sudden race and increase in awareness or whatever, these kinds of things where all of a sudden we reevaluate, the risk of something, in the same way as the risk may actually really physically get much worse because of much greater sort of like release of methane gas in Alaska or wherever the kind of the permafrost melts.
Yeah. Well, yes. Yes. There, people in the context of climate, scientists often talk about tipping points. So where things become nonlinear, and even more so in social situations. Yes, countries go to war, and all of a sudden you're in a completely different condition than you were before. And similarly, physical systems can undergo tipping points, and we may have passed, for instance, the point where Greenland is ultimately going to melt. There may be just so much heat in the oceans that process it's too late to stop. And if that's the case, that's 24 feet of sea level rise. And similarly with Antarctica, it's the same idea. We don't really know how much heat in the oceans will cause that whole ice sheet to destabilize, and that could be hundreds of feet. Now it's long into the future, and there's so much uncertainty about the future that we just have to think about all the different possibilities, but in particular the possibility that what we're doing today is causing the atmosphere to cross some tipping point that we're not aware of today, and that it's too late to turn things around. that's, what people worry about. And it's things like the Arctic, which, with the sea ice melting, that in itself doesn't raise sea level so much because it's floating, but it causes the ocean to turn dark, and all of a sudden it's absorbing a lot more heat than it used to every year, and so you get a nonlinear effect. The oceans this year, temperatures have gone up considerably more than they had in previous years, and so we're seeing impacts of that. There was also that volcano, that the underwater volcano that shot just tremendous amounts of water vapor into the atmosphere. Scientists think that may have caused some warming this year. And then there's the cleaning up of all the soot from ocean transport that is causing less pollution, and that can have a a warming impact. So all these things may be combining, and yeah, you could get tipping points, but whether we have such a tipping point or not, the impacts are just going to be increasing and increasing non-linearly. And I think that's what people aren't prepared for. Certainly in the space of weather events, and then you can also talk about disease and disease vectors that are moving out of the tropics up north where they've never been before. You've got the wildfire smoke that has impacts on health, tremendous impact, negative impacts on health. And you could imagine a worst case scenario where we've gone past the tipping point. I always say to people, when you're managing risk, time itself is a scarce commodity. It's a scarce resource. If you have enough time, you can solve any problem, whether it's climate change or financial or whatever. But it's when you run out of time that things get out of control, and that's what we have to worry about.
What I'm thinking from a financial point of view, if you were like Joe Biden and you had to think 20 years ahead and think, how much money do I have to put aside for to mitigate against climate catastrophe in the US? Can you put a figure to this, or is this just such a difficult thing to calculate because of the whole complexity? I mean, how do you actually, from a sort of a risk management perspective, advise on what kind of reserves to build up to mitigate against climate change? How do you, what is the current thinking on this?
Yeah, well, that's a great question. And the answer basically is a lot more than we're doing. The way people answer that question, I think, is helpful, is they say, look, today we're investing something like $1.5 trillion in low carbon capital or infrastructure technology. And we need to be investing 3 times that, something like $4 or $5 trillion per year in order to reach net zero by 2050. And net zero by 2050 is kind of the minimum rate of reduction of this risk that, it's something we've got to do. And so how do you get that 3 times investment? And why aren't we getting it? And the answer is, well, it's because it's not viewed as being profitable right now, or profitable enough. In other words, you get these entrepreneurs who are thinking about, okay, how can I make money by pulling CO2 out of the atmosphere, or not putting it into the atmosphere, in this process or whatever. Well, they're out there trying to get investment dollars, and guess what? They're getting a little bit from the government, and they're getting a little bit from philanthropy. They're not getting a lot from asset owners who are saying, gee, can I make money by investing in the next great technology for carbon sequestration? And they're not, for a very simple reason, that we are subsidizing fossil fuels to an extent that is just unbelievable. Now, this is not my view. This is the view of the International Monetary Fund, that has some good economists who have gone in and said, how big is the subsidies to fossil fuels? And what they find is that they are huge. In a recent report, they said it was a $7 trillion subsidy to fossil fuels in 2022. up from like 6 trillion 2 years earlier. And the increase was driven in large part by the war in Ukraine, which caused the European governments to subsidize energy to a huge extent this year. But the biggest part of that 7 trillion are the implicit subsidies that come from not putting a price on the particulate pollution, as well as the greenhouse gases that are emitted. And the IMF actually uses a social cost of carbon, in other words, the amount that they charge for that pollution, of $60 a ton. I think that is much too low. The think tank Resources for the Future, I used to be on their board, and they have really good environmental economists. Their recent estimate was $185 a ton. But what the IMF said is if you use that $185 a ton estimate, that's over $11 trillion, not 7 trillion. And in the US alone, that would be over $1 trillion in 2022. Now, you think about that amount of money, 11 trillion or 1 trillion in the US, the Inflation Reduction Act, which, the US government touts as its biggest, spending on climate, it was originally estimated at 370 billion over 10 years. And now maybe it'll get up to $1 trillion over 10 years versus $1 trillion of subsidy every year, in the US alone. So we're trying to move in the direction of low carbon. We've got a huge headwind.
And Bob, you have two potential if you like, sort of a twin solution, really, don't you? One is, which you are a great advocate of, is a carbon tax, and the other one, of course, is the carbon bonds. Which are kind of they attack this problem from different angles, but of course together they would exert some significant force, and they could begin to move the market. So before we move on to the carbon bonds, because that's obviously the core of what we're talking about today, say a few words about carbon tax, because again, it's very, very unusual for a investor of your caliber to say, hey guys, we need more taxes, we need a new tax. So this is quite unique. So maybe you could explain to me why you think that this would be a good thing and why it wouldn't damage the US economy in the long term.
Okay, well, let me start with, I'm trained in economics, but my undergraduate major was human biology, okay? And what I learned is that if you want to change behavior, and this is for any animal, okay, you have to change incentives. That's what incentives are. They are defined as things that change behavior. Anything that changes behavior is an incentive. And for humans, like any animal, you have to change incentives. So I like that word rather than taxes. But of course, incentives come in many forms. It could be a tax on pollution. It could be a subsidy for clean energy. These are all incentives. And, if you want to change behavior, you're going to change incentives. So that's what we've got to do. Now, people don't like to pay taxes. So we try to avoid that. We sometimes use the word fee. We sometimes use the word incentive. But ultimately, we have to create those incentives. And so one of the things that I found very interesting many years ago is we started looking at, I say we, and my firm, the investment firm, Kepos Capital, we started looking at where are there strong incentives to reduce emissions, and how are those changing over time. And we called this the carbon barometer, and it measures those incentives. And what we found is, first of all, they're much too low globally. Secondly, there's no harmonization of incentives whatsoever. And so that you have very strong incentives in Europe. You have essentially no incentives in the major polluting countries of the US, China, India. And then in a lot of countries in the Middle East, in Russia, in Venezuela, you have subsidies to fossil fuels, consumption of fossil fuels. And so the price on pollution is actually negative. So this is the fundamental problem that we have. And then you look around the world and you say, okay, how can you change those? And that's where the carbon-linked bond came in. It was an idea. The idea is basically, let's focus on these incentives and the lack thereof globally. So they're an order of magnitude too small. And, where is that? Why is that? And what can we do to increase it? And so that's where the carbon-linked bond came in. And
my listeners don't really know much about bond markets. So let's start really there. What exactly is a bond and what exactly is a bond market? How does it work in principle?
Yeah, well, the simplest idea, especially for a government, although it could be a corporate or anyone who's borrowing, to actually create an instrument, a promise, as it were, to pay back money in the future. And so typically that would include coupons, which are fixed payments at a given interest rate, say 3% coupon. Typically it's paid twice a year. And then the bond itself, the principal is repaid at the end of a maturity, which is typically, 10 years, could be 20 years, 30 years. So you have a maturity, a coupon, and that defines a typical government bond. The U.S. government bonds are considered the safest, but they still have at least some modest amount of credit if you're worried about the U.S. government or some other government defaulting. But anyway, that's what a bond is. And in the U.S. And in many other countries, there's a specific type of bond that is a wrinkle on the standard nominal bond, and that's what's called a inflation protected security, a bond where the coupon, rather than being fixed at say 3%, has a escalator in it, so that if there's inflation, the borrower pays the real rate of interest to the lender rather than a nominal rate. It protects the lender from unanticipated inflation. And so that, it turns out, is very interesting because it reveals that the price of that bond reveals what the market expects inflation to be. By comparing this real return bond with a nominal return bond, one can see that the market expects some or more inflation over the course of the bond. And that, it turns out, is very useful. I used to work at the Federal Reserve Bank in Minneapolis back in the 1970s when inflation was getting out of control. And the Federal Reserve was trying to get it back in control. And we had this theory at the time that rapid money growth causes inflation. And so every week, the Federal Reserve would publish a measure of money growth for the previous week. And these numbers were very noisy. They would bounce up or down, 10 billion, 2 billion, up 4 billion, and we would respond by basically pulling reserves out of the system, causing interest rates to go up if the money supply was too fast, or vice versa. It was kind of crazy because these money supply numbers were very noisy. You'd see a big blip up, $10 billion. Oh my God, we've got to respond. And then you get, to the end of the year, you'd look back, and because the data had now been, seasonally adjusted and corrections were made, and there was no blip there anymore. And you're saying, oh my God, what were we doing?
Well, this is interesting, because there's two aspects to this, isn't there? On the one hand, it sort of serves the private interest of the investor. He's protected against, if you like, movements in inflation. So, yeah. but that's a private interest. But then there's also the public good interest, which basically says it imposes discipline on governments, because of course it gets very, very expensive for the government if it basically inflates the value of its currency. And so there is a kind of a break on inflation, which has over time stabilized markets in significant ways, and that in some ways is the kind of the link you're making to the carbon linked bond, isn't it?
Exactly. It's about credibility. And you raised that issue early on about psychology. Well, yes, it's kind of psychology and it's credibility. And today, if you look at how central banks manage inflation, certainly in the U.S., it's very forward-looking. They talk about, their interest rate forecasts, their employment forecasts, and inflation forecasts. And in addition to what the Fed governors tell you, you can look at what the market thinks, and they look at what the market thinks. So indeed, when, you know, all of a sudden they call it break-even inflation, the inflation embedded in these bonds goes up, the Fed says, all right, we have a problem, we have to respond. And that feedback creates credibility so that the bond market investors think that the Fed will be able to control this, and they do. And so we need a similar credible policy for carbon. If we want to create the $5 trillion of investment that we need, then you back one step forward and you say, okay, what do we need? We need investors, private investors, to expect that they're going to make a profit when this capital is online over the next 10, 20, 30 years. And so how do we get investors to expect that profit? Well, we have to tell them that governments are going to make it expensive to pollute, and they're going to pay people who can suck carbon dioxide permanently out of the atmosphere. That's basically what we have to convince people. And that's what the carbon-linked bond is all about. It's basically a government coming in and saying, I promise you, we are going to price carbon. Now, you might be saying, I don't believe that. And that's true. I think it's a problem for a government like the US, which has shown no ability to put an adequate price on carbon. If they were to come in today and say, yeah, we're going to price carbon, I think the market would say, yeah, right, good luck with that. I don't believe it. And that would be revealed. Now, you might have a government that would step up and say, no, we are going to do this, and here it is. I don't think we have that government in the US. Now, we do have governments that are very credible and that are already pricing carbon, especially in Europe. That's where we see governments that have strong policies. You know, there's the emissions trading system, there's fossil fuel taxes, there's feed-in tariffs, there's a number of different policies used throughout Europe, which have basically created incentives over $100 a ton throughout Europe. The leading countries, you know, are UK, Spain, Germany, France, all have very strong incentives to reduce emissions. And by the way, the economies are much more fuel efficient. There's less carbon per unit of output in Europe than there is the rest of the world. And the US and China and India, the big polluters, have not gotten on board. And that's just unacceptable. And so the idea here of the carbon-linked bond is, by the way, very much to take into account the psychology of the public, of voters, which have short horizons. That's, you know, kind of well known. So when France, you know, wanted to raise the tax on petrol, you had the Yellow Vest movement. And in the US, there have been a lot of states that have tried to tax carbon, and they've had, you know, pushback as well in Oregon and Washington State. And eventually, some of these states have done it. We have a carbon tax in California. There's what are called the RGGI states, the regional greenhouse gas states in the East Coast. But most of the states in the U.S. do not. The U.S. as a whole has a carbon price, as we measure it, below the global average at about $18 a ton. Again, it's just an order of magnitude too small. So the idea here is to find governments that are, you know, leading, who have strong policies to price emissions, and to then issue a bond. You know, could be a 10-year bond, could be a 20-year bond, really whatever the government wants in terms of stating, here's where we're going with carbon pricing. Some governments have actually stated it without issuing a bond, like Singapore has said, okay, we're going to start with a relatively low carbon price, but it's going to go up, you know, quickly. Well, that's kind of what I have in mind in these carbon-linked bonds, is put it in. Here's the path we're going from where we are today into where we're going to be in, you know, 2030 or 2040, whatever it is, and then you know, show the credibility and policies that will hit that.
Let me ask a question here. I haven't fully thought this through, but I wonder what you think about this. Bonds are obviously issued by governments commonly. But of course, the cryptocurrency market, because currencies are also issued normally by governments. And now you have got these cryptocurrencies. Now, I just, wonder in what way would a crypto-backed bond, carbon bond, be different? That would be done by one of the big platforms, issued by one of the big platforms, as opposed to by a government. Would that serve the same purpose, or would that not work? And if so, why not?
Yeah, well, a corporation, a Bitcoin issuer could issue such a bond. They don't have the government authority to set policy. So in that case, it would be kind of a bet on another government or another, agency, but they could certainly issue such a bond, and such a bond would reveal where the market expects, carbon to be priced.
And it may indeed exert sort of some pressure on governments to follow through with policy, because of course, if significant amounts of capital would flow into that crypto market, then the investors would have an interest in policy to follow suit. No?
Well, if there's interest in effect betting on that carbon price, yeah, you could see that. I mean, yeah, and it would reveal a price, and that revelation might incent governments. So yeah, I mean, what you're saying could happen. It's just that it makes, I think, a little more sense for a government that wants to say, here's where we're going. I want you to see, and I want you to understand that I'm going to do this. That creates credibility itself, as opposed to, well, here's a betting arena where you can make a bet on whether the government is going to do it or not.
Now there's another aspect which I haven't fully thought through, but you probably have an answer to this. Do you know, if investors would start sort of selling short those bonds, essentially sort of, if you like, bidding against the government, in the way, say, Soros did against the pounds in the 1990s, and through the pound out of the European exchange rate mechanism. If that kind of dynamic would take hold, then that would massively kind of backfire, wouldn't it?
Well, that would show that the market does not anticipate that the government is going to follow through. Yeah, I mean, I don't think it's a backfire. I think it's a reality. If you ask today, what carbon price do you think the U.S. government is going to be putting on, what incentives in 2035? Because I have this great new technology. Let's say I'm an entrepreneur and I've just, come out of the lab with this membrane that separates, acid from base and salt water, and it's going to, revolutionize carbon sequestration. And I think I can do it for $100.
I get that,
but it's going to take me 10 years to get there. How do I finance that? Who's going to give me the money? Who's going to say, yeah, I bet that's going to be profitable?
I get that, but if you take if the investor can make money both ways, what incentive does the investor have to put pressure on government, or is that not part of your equation?
No, I think what you're saying is there a way, I hope this is what you're asking, is there a way that I, the entrepreneur, can lock in if the government promises $120 a ton, okay? And if these bonds start selling at $120 a ton, then yes, I can lock in that $120, because I can basically go long the bond, or I can go long a derivative instrument tied to the price of the bond. And if the government then doesn't hit that target, then they have to pay a higher coupon, the value of the bond itself goes up, and I'm protected. So I can go ahead with my project, and I don't have to worry about the price of it. I've in effect already sold that carbon forward through this market. Now, if what you're saying is, but wait a minute, people are going to come in and say, no, I don't believe they're going to actually hit that. I'm going to bet against it. And that in itself will cause the price of the bond to go up. If I haven't hedged yet, it's too late. And so now, basically the bond is expensive. It demonstrates that the market doesn't think the government is going to come through. And at that point, okay, that government isn't going to do it. Let's find a government where it is credible policy.
So there is really this, absolutely, but given that, I mean, we've said this already, that there's at the moment there's far too less or not enough money going into sort of carbon reducing or, whatever kind of technologies, startups,
Right.
industries. And then, of course, government subsidy will be, needed to kind of to kickstart this and to fuel it. But
Well,
if
government subsidies are there, but they're too small.
too small, exactly. So
The government is subsidizing fossil fuels 10 times the amount that it's subsidizing low energy. So of course we're going in the wrong direction. We've got to stop the government subsidies to fossil fuels and use that money to incentivize low carbon. If you force polluters to pay a tax, that's revenue to the government. If you have the government subsidizing clean energy, that's a cost to the government.
I understand that, but my point is this: if the government, as a result of getting its pricing wrong, in the same way as the UK kind of got something wrong in the 1990s and opened a window for Soros to come in, if that happens, then there is a financial risk to the government that goes beyond the sort of, if you like, the inertia of government, in the sense that at that point, a government might think, yeah, okay, even if we are honestly trying to price it, there is the possibility that, that the market moves against us. Maybe not even because of nobody's fault, but just the way that market dynamics build up. And all of a sudden, we're out of an awful lot of money and have even less money to spend on subsidies for sort of carbon reducing technologies and all the rest. Is there a way of kind of somehow putting governments at ease instead of saying, well, this is a kind of such an insignificant risk that the upside is so much greater that you should really kind of run with that? Or would you sort of caution governments to say, well, actually, there is a possibility that given the kind of the significant interest on the fossil fuel side, the oil majors, they have got significant resources with which they could disrupt that market if they wish to do that, if they would want to put a spanner in the works. And the question is there a way of sort of saying to governments, well, actually, there's a way of hedging against that risk in some ways, or is that something they would just have to accept as a kind of a part of that idea?
Well, the way I think about it is we've got to get globally harmonized pricing of emissions. That's the aim here. And how do we get there? The UN would be the obvious place that, if we had a global governance system that was up to the task, but obviously they haven't been up to the task. And so now the question is, how can governments coordinate going forward and create these these incentives to reduce emissions? And some countries are already, halfway there. Other countries, in particular, again, the US and China, have not shown the ability to create these kind of incentives. And that is why Europe, for instance, is putting on these, carbon border adjustments. And, that's what we've got to encourage. And really, I think what is at the heart of a carbon linked bond is the fact that what it does is it turns the typical equation, which makes it hard to raise prices on carbon, which is, the yellow vest problem, which is, if I say I want to raise carbon price today, I get a lot of pushback. People say, well, the benefit's way off in the future. I don't know if it's really worth it, but right now I can't afford it. That's the usual equation. Now with a carbon linked bond, what the government does is it says, all right, I'm going to borrow money from the future. I'm going to spend it now, and I can spend it really on anything I want. But in particular, I could spend it on, subsidizing EVs or batteries or hydro or, just basic research, whatever it is in low carbon. And by the way, I'm also promising that I'm going to price it in the future. So if you're an entrepreneur and you want to, find a good home for your investment, this is the place to do it. Encouraging that low carbon investment, promising to make it profitable in the future, causing that investment today. And the pain, so to speak, the carbon price is off in the future. And by the way, I told you it's coming, so it's not a surprise. It's coming. We all know we need it. And in the meantime, we're going to be working with China and, India and all the other countries to make sure that we all do this together and do it, quickly, because we need to get going.
I mean, I think it's a brilliant idea. I wouldn't have asked to meet you for an interview if I didn't. So I'm not being critical of it in general, but I'm just wondering how we can reduce the hurdle, how we can get this over the line. And so this is a question of how can we kind of reduce the risks for governments to actually take this on. This is really the background of my thinking here, because they will be thinking, oh, like if people bet against us, we could be losing our shirt. So how can we hedge against? How can we get it over the line? Because that's just such a showstopper. And so,
Yeah.
what
Well,
questions?
all right. So my theory of the game is someone starts and they're successful. And first of all, they have credibility. So it's not the U.S. It's another government, and they have credibility. They say, here's where we are today. Here's where we're going. And by the way, there's plenty of governments out there who, when they say, here's where we are, here's where we're going, people are like, okay, I get it. That government can do it. And then if that policy attracts more investment, and all of a sudden you get the green economy and the investment that you wanted in the direction that you want, and then you're putting pressure on other countries and saying, why aren't you? Where are you going to be pricing carbon? And where should we be pricing carbon? Because the bottom line is, right now, we have pathetically low incentives to reduce emissions. And so we're not moving fast enough. And, how do we get there quickly? We have to all move together. And so we have to create a coalition of the willing. And when you look around the world at, who is moving quickly, it's economies like Europe, which, does not have a lot of fossil fuel reserves. India is just getting started, but they don't have a lot of fossil fuel reserves. So they're going to move quickly to green economy, and China as well. China right now is the biggest polluter in the world by far, but they also are the biggest producer of, EVs, electric vehicles, batteries, wind. They know where we're going, and I think they're going to be willing to move quickly. So I think we all have to, and we all have to send those signals ASAP.
One last question about the way you visualize this carbon linked bond market. I mean, of course, governments have the option to limit the amount of bonds they issue. So and through that also, in some ways, limit risk, because obviously less money would be involved. Now, do you have a sense of what the minimal sort of capitalization, the minimum requirement would be for for liquidity levels to reach a point where this makes sense? What kind of market size are you talking about for this to try it out, to give it a first kind of go?
Yeah, well, that's a good question. I mean, I would say that there's no minimum size here. It's just relative to the economy that you're talking about, really. And we've seen with TIPS, that's the name of the U.S. version of these real inflation protected securities. That there can be a liquid market, and there can be derivatives on that. So if you want to bet on what they call break-even inflation, if you want to make a pure bet on inflation in the U.S., you can do it. Now, if you had a small country that would have a relatively small market, it wouldn't be able to handle trillions of dollars for sure, but it could handle millions, and it would just have to be relative to the size of the market.
And it would, of course, only relate to the economy of that country, because, of course, they would regulate their own carbon policies. This has been really, really, really a great discussion, Bob. Thank you ever so much. Last question, is anybody taking this on? Do you have any discussions with any government or anybody about this kind of in some shape or another moving forward? Or is this purely an academic idea at this point?
Well, it's an idea that none of these exist, but after that New York Times article that you saw was published, yeah, I've been contacted by a number of different states in the United States and then other countries that are interested in learning more about it anyway. So yeah, it's been very well received. There's a lot of interest, and we're moving forward.
If in a year's time some progress has been made, would you be happy to come on to another interview with me and to sort of reflect on, you know, how that year went and how this was received and what the actual, in practical terms, you know, what the worries and the kind of, you know, what the actual feedback is and how possibly to move forward with this? Would this be something, because I'd like to kind of stick with this and see how this evolves. Would you be happy to come on again in 10 years' time?
Well, I promise you I'll come back. I hope it's with good news.
That is really very kind, Bob. Thank you ever so much. I know you had to push out another meeting, so I want to really finish on the dot. Thank you ever so much. It's been a really marvelous conversation, and I wish you the very best of luck with this. And hopefully we speak again in about 12 months' time.
Hopefully. Thank you so much. My pleasure.
Thank you ever so much. Have a good day. Bye-bye.
Thank you. Bye.